Okay, so you want to own a harbor. You open up a map of global trade and look at the numbers. You see that 90% of everything the world consumes, the phones in our pockets, the grain in our silos, the neon signs illuminating our cities, is carried on the back of the ocean. You watch massive container vessels, steel monsters stretching over, 400 meters long, lining up outside deep-water terminals like obedient giants. To the untrained eye, owning a harbor looks like the ultimate capitalist cheat code. It presents itself as a natural monopoly, a physical toll booth anchored to the crust of the earth, completely immune to inflation, political cycles, or digital disruption. After all, nobody can just wake up and manufacture a new coastline. But this is the part where the logic breaks and the financial reality fractures for most people. Welcome to the ultimate paradox of maritime infrastructure. On paper, you are the undisputed landlord of global commerce. In reality, harbors are a ruthless, capital-intensive graveyard where some of the most sophisticated sovereign wealth funds and private equity firms come to watch their balance sheets bleed out. It is a game played on razor-thin return on assets, where a port can achieve record-breaking volume in terms of 20-foot equivalent units and still slide gracefully into technical bankruptcy. You see a fortress of concrete and steel, while the bond market sees a terrifying vortex of fixed costs and volatile, unpredictable demand. Everything on the surface looks like an automated money machine, but everything beneath it is a bare-knuckle fistfight against forces you cannot control. To truly understand why the wealthiest entities on Earth repeatedly break their teeth on these concrete shores, we have to look past the marketing brochures of maritime logistics and ask the questions that institutional investors whisper behind closed doors. First, why would a sovereign state or a consortium of global funds willingly inject billions of dollars into constructing a mega-terminal when the cold, hard math of loading and unloading fees proves the asset can never organically recoup its initial capital expenditure within a 30-year concession window? Second, in the grand arena of international trade, why is it that the landlord who owns the physical, irreplaceable gateway to a continent is routinely squeezed, outmaneuvered, and financially suffocated by ocean carrier alliances, entities that do not own a single square meter of the dirt they are docking on? If you believe that a harbor's primary business is providing a patch of water for ships to park or operating giant yellow cranes, you are looking at the theater, not the business model. To survive this game, you must look past the heavy machinery and define what a port is actually selling. The asset you are holding is not a physical piece of marine infrastructure. The true, invisible commodity of a harbor is throughput efficiency, which is the commercial monetization of time and the absolute control over supply chain land rent. To a mega container ship burning tens of thousands of dollars in fuel and charter costs every single day it idles at sea, time is a toxic asset. When that ship enters your shipping channel, it enters a state of economic captivity. A harbor is a captive audience model on a macroeconomic scale. Once a vessel commits to your geographic coordinates, the ocean carrier loses all optionality. They cannot pull over, and they cannot choose a different route on a whim. What you are selling them is an insurance policy against operational friction. You are selling the guaranteed velocity of capital. The faster a container moves from a ship's hold to a rubber-tired gantry crane and onto a chassis, the more valuable your territory becomes. Let that sink in for a moment. You are not in the transportation business. You are a tax collector on geographic dependency. This dependency is dictated entirely by a concept known as the Hinterland, which is the economic backyard that your harbor uniquely commands. A port without a hyper-connected hinterland is merely an expensive concrete pier jutting into empty water. The true power of a harbor landlord does not stop at the high water mark. It extends hundreds of miles inland through dedicated rail corridors, inland dry ports, and congested interstate highways. If your harbor is the sole efficient gateway to a massive industrial manufacturing hub, or a metropolis of 50 million consumers, you possess an absolute spatial monopoly. In this structural matrix, the harbor acts as a strategic choke point. By controlling the maritime gateway, you gain the systemic leverage to dictate the terms of the logistics zone surrounding it. You are not just leasing space to ships, you are extracting economic rent from every warehouse, every distribution center, and every manufacturing plant that relies on your physical node to access the global market. The harbor creates a localized gravitational pull. Because cargo naturally flows through the path of least resistance, the entity that owns the choke point effectively holds an equity stake in the economic output of the entire region. The physical harbor is merely the bait, and the real commodity is the monopolistic capture of the regional supply chain's cash flow. To dissect the financial machinery of a harbor, you must learn to look at a port terminal the same way a casino analyst looks at the Las Vegas Strip. The flashing lights and the high-stakes tables are there to draw the crowds, but the real margin is hidden in the backrooms, the hotel mathematical algorithms, and the structural traps designed to keep you from leaving. In the maritime world, this is the split between your aeronautical or marine revenues and your non-marine or concession revenues. One is a high-visibility, low-margin necessity, while the other is where the real economic empire is built. Let us begin with the surface layer of marine revenues. These are the fees billed directly to the vessels themselves, including berthing fees, pilotage, tugboat escorts, and tonnage dues. On a corporate spreadsheet, these numbers look immense. A single megaship docking at your terminal can trigger a bill for hundreds of thousands of dollars just for the right to tie its thick nylon ropes to your iron bollards. But here is the structural trap that breaks the calculations of amateur investors. Marine revenues are fundamentally defensive. This cash flow is almost entirely swallowed up by the brutal, ongoing operational expenditures required to keep the harbor functional. You must constantly spend millions on capital-intensive maintenance dredging just to combat the natural siltation of the sea floor. If your shipping channel loses even 1 meter of depth due to mud and sand accumulation, the world's largest carriers will instantly blacklist your port. Let me repeat that, because it is crucial. The money you collect from the ships themselves is barely enough to keep the ocean from reclaiming your floor. The real gold mine lies within the non-marine matrix, specifically driven by operational penalties and deep structural contracts. Consider the mechanics of demurrage and detention fees. In a perfectly optimized global supply chain, containers land on your dock and vanish onto trucks within 24 hours. But the global supply chain is rarely perfect. When a logistics bottleneck occurs, whether due to a customs delay, a shortage of truck drivers, or inland rail congestion, your container yard turns into an involuntary storage warehouse. This is where the harbor transforms from a transit hub into a predatory monetization machine. For every day a container sits past its allowed free time, the cargo owner is hit with escalating demurrage penalties. During massive supply chain crises, harbors don't lose money, and their terminal operators experience a violent surge in profitability because they are charging premium rent on every square meter of concrete occupied by stranded cargo. To lock in this cash flow and mitigate the immense volatility of global trade shipping cycles, institutional harbor owners rely heavily on the landlord-port model. In this setup, you do not actually manage the cranes or hire the longshoremen yourself. Instead, you lease individual terminals to third-party operators, which are often the container shipping lines themselves or specialized mega-operators like DP World or Hutchison Ports, through long-term concession agreements spanning 30 to 50 years. The structural core of these concessions is the minimum assured guarantee clause. A minimum assured guarantee contract dictates that the terminal operator must pay the harbor authority a fixed, non-negotiable baseline revenue every single year, regardless of whether global trade collapses, a pandemic locks down manufacturing, or a war reroutes shipping lanes. If the operator promises to move 1 million 20-foot equivalent units a year but only manages to move 600,000, they must still cut you a check for the full million. This mechanism effectively shifts the volume risk entirely off the balance sheet of the harbor owner and onto the operational backs of the tenants. Furthermore, sophisticated harbor engineering utilizes spatial architecture and psychological confinement to maximize what is known as the captive audience effect inside the port boundary. Much like a modern airport or a mega shopping mall, the physical layout of a harbor is intentionally designed to force logistical dependency. The modern container yard is arranged in a rigid, one-way algorithmic flow. By meticulously controlling the physical entry and exit checkpoints, the harbor forces external trucking companies, freight forwarders, and customs brokers into a closed ecosystem. If a logistics provider wants access to the rapid clearance lanes, they must rent space within the port's proprietary logistics zone. If they need to refuel, repair chassis, or store empty equipment, they must use facilities owned or heavily taxed by the harbor authority. By embedding clauses like co-tenancy, where the tenancy of a warehouse is legally tied to the operational performance and utilization of a specific shipping terminal, the harbor creates a web of interlocking contracts. You are no longer just running a dock, you are operating a closed financial ecosystem where every turning wheel, every idling engine, and every delayed shipment pays a direct fraction of its value to your bottom line. Now we must step away from the cash flow matrix and look directly into the darkest corner of a harbor's balance sheet. This is where the structural trap snaps shut. In the world of corporate finance, harbors represent the absolute zenith of operating leverage. To build or expand a modern port terminal, you cannot phase your investments incrementally. You must deploy billions of dollars up front. You have to blast through granite, pour millions of tons of maritime concrete, and install automated ship-to-shore gantry cranes and automated guided vehicles before a single dollar of revenue can be generated. Once these assets are anchored into your geography, your financial structure hardens into a terrifying reality. 60% to 70% of your total operational expenditure becomes completely, structurally fixed. Let that sink in for a moment. This is the part where the financial engine turns into a meat grinder for careless capital. When a macroeconomic shockwave hits the globe, whether it is a synchronized consumer slowdown, a sudden trade war, or an abrupt rerouting of major shipping lanes, the volume of cargo flowing through your gates can drop by 20% to 30% in a matter of weeks. In a standard corporate business, a chief executive officer facing a massive revenue drop can immediately scale down operations, lay off variable staff, or shutter underutilized factory floors. But a harbor landlord possesses no such luxury. A port cannot hit the pause button. Your debt obligations, typically structured as massive, decades-long infrastructure bonds or syndicated bank loans denominated in hard currencies like US dollars, do not care about global shipping recessions. The interest calculations spin forward every second of every day from the exact moment capital was dispersed. Simultaneously, the physical asset demands constant, relentless maintenance regardless of utilization. The ocean does not stop trying to reclaim your shipping channel just because global trade is down. The silt keeps piling up, requiring millions of dollars in non-negotiable maintenance dredging contracts to keep your deep water status. The complex, automated terminal operating software requires ongoing licensing fees. The heavily unionized labor force protected by ironclad longshoremen agreements frequently operates under guaranteed shift structures that dictate payment, even if cranes stand idle. When your variable revenue drops, that monolithic block of fixed costs stays completely stationary. Because of this high operating leverage, a minor dip in global trade volume doesn't just cause a minor dip in your profits, it triggers a violent, exponential collapse in your corporate earnings. Your profit margins vanish into thin air, and your debt service coverage ratios rupture. Within a few quarters of low volume, a harbor can transform from a prized crown jewel of infrastructure into an active financial parasite, devouring the corporate liquidity of its parent company, or pushing sovereign states toward the brink of fiscal collapse. Everything below the surface of this business is a brutal race against time. You must move containers fast enough to outrun the crushing, automated rhythm of your fixed cost ledger. To prove that the fixed cost trap is not a theoretical abstraction, we must examine the scarred landscapes of maritime history. The financial graveyards are filled with megaports built by brilliant engineers and financed by massive institutions, only to be dismantled by the cold, unyielding mechanics of systemic risk. A harbor does not fail because it operates poorly on a random Tuesday. It fails because a single, critical domino in its macroeconomic architecture is pulled out, causing the entire multi-billion-dollar structure to implode under the weight of its own leverage. Consider the absolute textbook warning of modern infrastructure failure: the Hambantota International Port in Sri Lanka. In the early 2010s, the Sri Lankan government looked at a map and saw a golden opportunity. Hambantota sat a mere 10 nautical miles from the primary Indian Ocean shipping lane, a maritime superhighway carrying half of the world's container ships and 2/3 of its oil shipments. The plan seemed foolproof. By borrowing over $1.3 billion, primarily through high-interest loans from the Exim Bank of China, Sri Lanka blasted through rock and opened a massive deep-water facility. But the planners committed a fatal intellectual error because they mistook a geographic coordinate for an economic ecosystem. They completely ignored the concept of the hinterland. Hambantota sat in a rural, underdeveloped region with zero industrial manufacturing capacity, no local cargo generation, and no integrated inland rail network. Ocean carriers operate on razor-thin schedules, and they do not drop anchor at a port merely because it is nearby. They pull into a port because there are goods to unload and local factories waiting to fill their empty containers. Hambantota possessed none of this. By the mid-2010s, the port was empty, occasionally drawing fewer than 30 major ships a year. The variable revenue was practically non-existent, but the fixed cost engine was firing on all cylinders. The interest payments to the Chinese creditors were non-negotiable, and the maintenance costs of keeping the basin clear of silt kept piling up. By 2017, the fiscal weight of the asset threatened to drag the entire sovereign nation into a balance of payments crisis. Desperate for liquidity, the Sri Lankan government was forced into a humiliating geopolitical retreat. They signed a 99-year concession agreement handing over 70% control of the port and 15,000 acres of surrounding land to China Merchants Port Holdings in exchange for $1.12 billion in debt relief. Pause and really think about what that means. A nation traded 99 years of its sovereign territory just to wipe clean the bad math of a single fixed-cost gamble. If you think this structural vulnerability is confined to developing nations, look closer at the heart of the global financial system, where the shockwaves of the mid-2020 supply chain realignment smashed straight into the balance sheets of Western infrastructure funds. For years, Dubai-based logistics giant DP World and various private equity consortiums aggressively expanded their global terminal footprints, using heavy debt loads, betting that the post-pandemic supply chain boom would continue indefinitely. However, by 2025 and heading into 2026, the geopolitical tectonic plates shifted violently. Ongoing security crises in the Red Sea forced major shipping lines to permanently abandon the Suez Canal route, choosing instead to route their megavessels all the way around the Cape of Good Hope. Simultaneously, the historic fracturing of global ocean carrier alliances in early 2025 completely rewired the global network of transit points. Suddenly, massive transshipment hubs in Europe and the Mediterranean found themselves completely bypassed by the new maritime routes. Ports that had spent billions upgrading their cranes to handle megaships saw their cargo volumes drop by over 35% in a matter of months. Because these acquisitions were funded using highly leveraged infrastructure bonds with floating interest rates, the drop in volume was catastrophic. By late 2025, several highly rated maritime infrastructure funds faced severe liquidity crunches as their debt-to-earnings leverage ratios blew past covenant thresholds. The asset value of major terminal concessions across the European perimeter plummeted by over a third from their peak valuations. Operators were forced to halt capital expenditure on automation, fire-sell minority equity stakes to rival sovereign wealth funds, and enter painful restructuring negotiations with syndicates of global banks. The lesson of these dual failures is stark and absolute. Whether you are a sovereign state building on an empty coastline or a Wall Street private equity firm buying an established terminal, a harbor cannot protect itself from systemic rerouting. The physical infrastructure is completely stationary. You cannot move a concrete dock to a new country when trade patterns shift. If the ships stop coming, your asset instantly reverts to what it fundamentally is, a multi-billion-dollar block of submerged concrete wrapped in an unbreakable debt contract. To master the economics of a harbor, you must understand that this is not a linear business. It is a game dictated entirely by a ruthless hierarchy of scale. The financial physics that govern a small regional dock will utterly collapse when applied to a global transshipment hub. To survive, an investor must know exactly where their asset sits on this ladder of power and whether they are holding a minor toll booth or a systemic sovereign weapon. At the bottom of the food chain sit the feeder ports, which are the small, local docks scattered across regional coastlines. These assets operate on razor-thin operating margins and exist in a state of constant financial vulnerability. They do not have the deep-water channels required to handle modern megavessels, meaning they are entirely dependent on whatever scraps of cargo are dropped off by larger ports. Their earnings are highly volatile, their bargaining power against local trucking cartels is non-existent, and they are frequently forced to survive on government subsidies just to cover their basic maintenance dredging costs. At this scale, owning a harbor is not an investment. It is a liability wrapped in concrete. Move up the ladder, and you find the gateway ports, which are the sweet spot of maritime cash flow. These are the mid-sized to large facilities that control the direct access to a highly industrialized, captive hinterland. Because they sit at the mouth of major manufacturing corridors or massive consumer populations, they do not need to fight for volume. The cargo has no choice but to flow through them. Gateway ports possess massive pricing power, allowing them to comfortably squeeze their tenants, enforce aggressive minimum assured guarantee contracts, and maintain an incredibly stable, predictable profit margin. At this level, the operating leverage works entirely in your favor. But at the absolute apex of the food chain lie the global hub ports, the hyper-automated titans like Singapore, Shanghai, and Rotterdam. These are the endgame bosses of the maritime world, dominated by systemic giants like PSA International or AP Moller, Maersk through its terminal arm, APM Terminals. These entities do not just own docks, they own the entire global matrix. They integrate ocean carrier fleets, automated rail networks, and proprietary digital logistics software into a single, seamless ecosystem. Their earnings are measured in the billions, and their efficiency is terrifying. Yet this absolute monopoly comes at a heavy price. The global hubs are trapped in an endless, multi-billion-dollar arms race. To prevent being bypassed by rival nations, they must continuously issue massive mountains of debt to finance deeper channels, larger berths, and fully automated artificial intelligence terminal systems. They carry leverage ratios that would bankrupt a normal corporation, operating under the implicit guarantee that they are too vital to the global economy to ever be allowed to fail. They are no longer mere commercial enterprises. They are the physical infrastructure of global geopolitical power. In the final calculus, the illusion of owning a harbor is shattered by the reality of what you are truly commanding. Most people look at the ocean and see an untamable, chaotic expanse of open water. The amateur investor buys a ship, believing that the power lies in the movement across the waves. But the financial elite know better. The true sovereign of global commerce is the one who controls the bottlenecks, where that movement must inevitably grind to a halt. You do not conquer the oceans by building a larger fleet of ships. You conquer them by owning the gate through which they must all pass, and by dictating the price of the very ground where they must cast their anchor.